If you are a NRI or even OCI planning to return to India permanently, whether from US, Canada, Singapore, Dubai, or elsewhere, this video will help you understand what you must consider to navigate the process smoothly. Moving back involves more than just packing bags. It requires careful financial and tax planning to avoid costly mistakes, and most importantly, rediscovering your love for India. So, this is you, and this is the country where you are resident for tax purposes. And this is India. As an NRI, you are currently not paying any taxes on your foreign earning in India. If you have any earning in India, then you must pay taxes on what you earn. For example, rental, investment, dividend, etc. If you have. In the country where you live, the tax rule will determine how you pay taxes. For example, here in Canada, as a resident, you will pay taxes on worldwide income. So every country has their different rule, which I'm sure by now you would know and you will be aware of what it is in your place. When you're permanently leaving the country, in most country, you'll have to pay departure tax. Basically, you're saying that you are leaving the country permanently, and depending on how the country's tax law is, for example, some country might say to close everything before you leave the country. If you have any investment, you take it out. If you have any money in bank, you take it out. And when you do that, many countries impose a deemed disposition of asset when you deal, treating investment as a sold and triggering capital gain tax. A lot of people get surprises here. For example, in Canada, you file Form P1161 and 1243 for departure tax reporting. If you are in US, green card holder or long-term resident, you may need to fill Form 8854, which is an expatriation statement. Similarly, Germany, you have to file the tax return. Australia, you have capital gain tax, which may apply to certain asset. Singapore and Dubai, where there is no capital gain tax, you may want to check local banking rules for non-resident. Then based on your last day, you pay any taxes that you owe and then make a clean exit. Once you are out, depending on your situation, your country might determine what you are considered for tax purpose. When you bring this money to India, when you move, India don't tax you on this money that you are bringing in. Here you basically transfer your money either through bank to bank or through exchange to bank, which is Indian bank account, where you will pay exchange fee and your Indian bank account will receive this in INR. When will you be taxed? We will learn in some time. Before that, let me give you an example of Canada. And with this, you will know exactly what question you need to ask your tax consultant. In Canada, if someone lives in Canada and has a strong ties, that is house, spouse, dependent, social benefit, then the person is taxed on worldwide income. If non-resident, where the person has severed significant ties and has no Canadian income, then no tax on foreign income. If a person is deemed resident, that is having ties with two countries, then tax treaty determines where the primary tax will be done, which country it will be done. So that's why you need to consult with a professional tax consultant. In some countries, they allow you to keep your investment as it is with the condition that as a non-resident, you cannot make any new contribution. So some make use of it. When someone moves to India thinking that this is a stopgap arrangement and we will return soon back to this country, this could prove a costly mistake later if you are still staying in India beyond certain time. The best way to exit, that's why a country is to close everything and then move to India. No house, no rent, no dividend, no stock, no investment, no interest coming from this country, no non-resident bank account, no credit card, no subscription, no membership abroad, and you have paid all your taxes. This is neat and clean. Once you move back, your tax status changes. You may qualify as a resident, but not ordinarily resident initially, offering partial tax relief on foreign income. After this RNOR status expires, you will be taxed on worldwide income, and this is when many get surprised. And if you have not planned well, you will be there for surprise. Simplify your life by closing non-essential holding to avoid dual compliance. You pay taxes in India, then you also have to do with tax filing in this country where you were earlier stayed. And remotely, this might be a challenge. Also, in this country, even if you are holding tax advantage account, for example, tax-free saving account in Canada, where as a resident, the money what you have invested and grow both are not taxed. You cannot make new contribution to this account as it attracts penalty if you are a non-resident. But whatever you already have and grows remains tax-free. When it comes to India, it does not recognize tax-free status. Any dividend you get will be taxed. So ask this question to your accountant. So far, we talked about the taxes. Let's see the settlement part. When moving back to India, buying a property immediately is like committing to a place. Instead, renting initially will give enough time and flexibility to test and commit. And by then, you will figure out about workplace, traffic, commute, amenities that matters to you, like hospital, schools for kids, etc. And then take an informed decision. When I was in Bangalore, my commute from home to office was 1 hour 30 minutes, one way. And if I have to think about how I would fix this, is to reduce this commute time for sure and stay closer to workplace. Once you are on ground, you will have first-hand experience of many things. I'm sharing the ballpark figure of buy versus rent, and you can also do some research to get to the ballpark. When it comes to healthcare, many of the insurance policies have a waiting period. So you might want to start this even before landing, and this way you can reduce the wait period. So having a conversation with a policy provider will be handy. You can ask them about the global coverage. Recently, someone who I know was struggling with knee pain for almost 2 years in Canada decided to go to India. Within few days, got admitted, got the surgery done with a total cost of about 3.5 lakhs and is also recovering well. So majority of such expenses can be taken care by the insurance if a person is planning well. Most of the healthcare services will be 80% less than what you find in US and Canada, and you will not have this much of wait time. Research on cost of living, for example, when I went to India last time, here is my analysis of the place where I am. You can download this to make your own estimate as it depends on your lifestyle, personal situation, etc. As you might not need a car if you already own a car. Same goes with the house. And then few other, lifestyle things. So returning to India is an exciting journey, but a smooth financial transition takes careful planning. Start early, consult professionals, and wrap up those loose ends to avoid any surprise. Most importantly, embrace the change with an open mind and make the most of your new chapter. Wish you all the best in your new journey. Thank you.